Overpay your mortgage, save, or invest. To find out how you can get free shares, be sure to watch until the end of the video. Choosing what to do with your spare money can result in thousands earned in interest, saved, or accumulated through asset appreciation. Overpaying your mortgage, adding your money to a high-rate savings account and investing in stocks are all viable ways of generating more wealth. So, which is best? Before committing to these options, there are some things to consider. 1. Establishing an emergency fund. Make sure you have a complete emergency fund that covers at least 6 months' worth of expenses. Emergency funds are important, as you cannot access the money used to overpay your mortgage, and investments may need to be sold at a loss, should you need emergency cash. 2. Fund short-term goals. Ensure you have sufficient funds for any short-term financial goals you may have within the next year, as mortgage overpayments and investments are medium to long-term tools. 3. Evaluate pension contributions. Assess whether your pension savings are on track to provide a comfortable retirement, as pension contributions often offer substantial tax benefits. Mortgage overpayments versus cash savings. Mortgage overpayments provide a guaranteed, risk-free return, equivalent to the interest rate on your loan. Similarly, cash savings in a bank savings account or cash ISA also offer a risk-free and guaranteed return. Because of this, they are directly comparable to each other. If your savings account has the same interest rate as your mortgage, allocating your monthly savings to either option would yield identical results. Therefore, the decision is straightforward in this case. Choose the option with the higher interest rate. If you find a savings account with a higher interest rate than your mortgage, saving in that account would be more financially beneficial. Conversely, if your mortgage interest rate exceeds the available savings rates, overpaying your mortgage is the better choice. The greater the difference between the two rates, the more significant the difference in your return. Remember to consider the impact of taxes on savings interest when comparing rates. Mortgage overpayments versus investments. To achieve significantly higher returns than your mortgage's interest rate, you generally need to invest in assets that carry some level of risk. Investment returns are not guaranteed, like the interest rate in a bank account, and they can fluctuate in the short term. Historically, long-term investments have provided average nominal returns between 4% and 7%, assuming a 2% inflation rate. However, comparing mortgage interest rates to long-term investment returns involves comparing certainty to probability. Some individuals may value a guaranteed 4% return over an investment with an average return between 4% and 7%. Generally, investing becomes more attractive than debt repayment when the debt carries low interest rates. In a rising interest rate environment, savings and overpayments may yield a higher or similar return, with little to no risk. It's important to consider other factors and consult a financial advisor when making these decisions. Additional factors to consider. 1. Mortgage overpayments are illiquid. When you make a mortgage overpayment, the money becomes inaccessible unless you remortgage your property, which incurs costs and takes time. In contrast, cash savings and investments are very liquid, allowing you to access the funds more easily. However, having readily available savings may increase the temptation to dip into them frequently. 2. Mortgage overpayments are tax-free. Overpaying your mortgage provides tax-free savings, unlike the interest earned from savings or investment accounts. Although many people in the UK won't pay tax on savings interest or investment growth, due to various tax allowances, it's important to consider the tax implications. 3. Psychological benefits of mortgage overpayments. Fully paying off a mortgage is often seen as a significant financial milestone, providing a sense of excitement and satisfaction. It's important to balance this psychological benefit against a potentially more optimal financial solution. However, this will be down to personal preference. Ultimately, you don't necessarily have to choose between overpaying your mortgage or saving and investing. You can find a balance that suits your preferences, and you can adjust your strategy as interest rates change over time. Is it beneficial to make overpayments to improve my loan-to-value, LTV, and interest rate? Lenders typically offer better rates when your loan amount is smaller relative to the property's value, known as loan-to-value, LTV. For example, if making a £10,000 overpayment on a £200,000 loan reduces your interest rate from 2% to 1.5%, you would save £1,000 per year in interest. This saving is roughly equivalent to a 10% annual return, in addition to the interest saved on the repayment amount itself. The thresholds for improved rates based on LTV can vary, though they usually fall at 90%, 80%, 75%, and 60%. If your mortgage is nearing renewal and your LTV is close to a threshold that would result in a better rate, it's worth considering the advantages of this approach. Are there fees for overpaying a mortgage? It depends on the lender. Most lenders allow a 10% overpayment of your mortgage balance each year, without penalty fees. However, every lender has different terms and conditions, so you should review your mortgage agreement. If you wish to pay more than the overpayment allowance, you may face early repayment charges, often calculated as a percentage of your mortgage balance. These charges only apply during the fixed rate period. If you plan to make overpayments substantial enough to incur early repayment charges, it is usually beneficial to wait until you can overpay for free, such as during the remortgaging process. In this case, you can remortgage for a lower amount and use your savings to cover the difference. Decided that you want to overpay. How do you do it? First, use a mortgage overpayment calculator to give you an idea of how much you could save by overpaying. You can find many free calculators online, and in this video description. Understand the costs. Ensure that you have a clear understanding of any fees associated with overpaying your mortgage. You can find this information in your mortgage documents, or by contacting your lender. If fees are involved, it may be beneficial to consult a mortgage advisor who can assist you in assessing whether overpaying is a worthwhile decision. Contact your mortgage provider. Most lenders have systems that let you overpay online, which might be the easiest option. You can also call or go into a local branch to arrange the overpayment. Your lender will then give you some options on what impact you'd like the overpayments to make, such as increasing your monthly repayments each month, and shortening your mortgage term, using an overpayment lump sum to shorten your mortgage term, while keeping your repayments the same, or using an overpayment to reduce future monthly repayments. The first two options have the advantage that they reduce the size of your debt, and shorten your mortgage term. Once you have decided, you agree with your lender on how the payment will be taken. This overpayment can usually be done by paying an increased fixed amount every month, therefore increasing your repayments, or transferring a lump sum of savings. Decided that you'd like to invest, instead. There are many great brokers to choose online. We will cover these in a future video. In the meantime, you can get free shares when you sign up to Trading 212, using the link in the description. Decided to save your cash, instead. We will cover what to look out for in savings accounts, in a future video. Subscribe to ensure you don't miss out.